Mutual funds have become one of the most accessible, beginner-friendly, and life-changing wealth-building tools in the world, yet most people still treat them like a mystery. The truth is that mutual funds were created to help ordinary people build wealth without needing advanced financial knowledge, massive capital, or the time to study the markets. And the greatest tragedy for most people is that they hear the term mutual fund, assume it's too complicated, and then walk away from something that could completely change their financial future. This video is designed to change that because by the end of this full guide, you will understand exactly what mutual funds are, how they work, which ones fit your goals, how to calculate returns, how to avoid the traps that make investors lose money, and how to use mutual funds to build long-term financial freedom in the most stress-free way possible. The introduction to mutual funds must begin with the reason they exist in the first place. The financial world has always been complex, unpredictable, and overwhelming for most people. Only a small percentage of individuals have the time, confidence, or expertise to study stocks, analyze companies, interpret macroeconomic trends, and monitor financial markets every single day. The majority of people are busy living their lives, earning a living and trying to make sense of money without the tools to do it efficiently. Mutual funds were designed to bridge the gap between ordinary people and the world of professional investing. They allow anyone, regardless of income, education, or financial background, to participate in wealth creation without needing to be a financial expert. This is why mutual funds are often called one of the greatest equalizers in personal finance. They give everyone a chance to grow wealth without needing to master the stock market on their own. To understand mutual funds properly, you first need to know what they truly are. A mutual fund is a pool of money collected from multiple investors who share a common investment objective. Instead of investing alone, your money is combined with the money of thousands of others. This pool is then invested in a diversified portfolio of assets, such as stocks, bonds, government securities, real estate instruments, and sometimes a combination of these. Each mutual fund has a defined purpose, strategy, and risk profile. Some funds focus on growth, others focus on stability, and some try to balance both. When you invest in a mutual fund, you don't own individual stocks or bonds directly. Instead, you own units of the fund, which represent your proportional share of the entire portfolio. This structure allows investors to benefit from diversification instantly, something that would otherwise require large sums of money if done independently. Understanding how mutual funds work is crucial because it gives clarity on why they are so powerful. When you invest your money into the fund, a professional fund manager takes on the responsibility of allocating your money into different securities according to the fund strategy. These managers are backed by research analysts, economists, and financial experts who continuously monitor the market. Their job is to select assets that align with the fund's objective and to adjust the portfolio when market conditions change. As the value of the underlying assets moves up or down, the total value of the fund changes accordingly. Since each investor owns units of the fund, the value of these units also changes. The goal of the fund is simple: grow the value of the underlying portfolio over time while managing risk according to the fund's mandate. This structure benefits investors because the responsibility of decision-making lies with professionals, reducing emotional mistakes that individuals usually make when investing alone. One of the most important parts of understanding mutual funds is learning the different types available, because each type serves a unique purpose and has its own risk and return characteristics. Equity mutual funds invest primarily in stocks and aim for long-term capital appreciation. These funds offer high growth potential but come with higher short-term volatility. They are ideal for long-term goals like retirement, building wealth, or generational planning. Debt mutual funds, on the other hand, invest in fixed income instruments such as government bonds, treasury bills, corporate bonds, and money market securities. They focus on capital preservation and steady income, making them suitable for short to medium-term goals where stability is a priority. Hybrid mutual funds combine both equity and debt, offering a balanced approach where investors can enjoy moderate growth while reducing risk. Then there are index funds, which track market indices and offer low-cost passive investing. They are increasingly popular because they deliver market returns with minimal fees and require no active management. These categories form the foundation of mutual fund investing, and choosing the right one depends entirely on your risk tolerance, investment horizon, and financial goals. To navigate mutual funds confidently, you must understand one key metric, NAV, which stands for net asset value. NAV represents the value of one unit of a mutual fund. It's calculated by taking the total value of all the assets in the fund, subtracting liabilities and expenses, and dividing the result by the total number of units held by investors. Many beginners mistakenly compare funds based on NAV, thinking a lower NAV means a cheaper or better investment. In reality, NAV has nothing to do with whether a fund is a good or bad investment. A fund with a NAV of 10 and a fund with a NAV of 100 can both grow by 10% and deliver the same return. NAV simply tells you the price per unit on a given day. What truly matters is the fund's performance history, consistency, risk profile, management quality, and expense ratio. When the underlying portfolio grows, the NAV increases, and that's how your investment earns returns. When the portfolio declines temporarily, the NAV falls, but long-term investors understand that fluctuations are part of the process. When you invest in a mutual fund, you're essentially buying units based on the current NAV. If a fund has a NAV of 20 and you invest 10,000, you will receive 500 units. Over time, as the NAV changes, the value of your units rises or falls. The number of units you own stays the same unless you invest more or redeem units. What you're ultimately tracking is the growth of NAV, because that determines whether your investment grows or not. Understanding this unit structure helps investors avoid the emotional trap of comparing NAVs or assuming that funds with lower NAVs are more affordable or promising. The performance of a mutual fund is measured by percentage return, not NAV size, and that is the metric that should guide your decisions. Another essential piece of the mutual fund puzzle is understanding the difference between SIP and lump sum investing, and how rupee cost averaging becomes one of the most powerful strategies for long-term investors. A lump sum investment means investing a large amount at once. This approach works best when you already have significant savings or when the market experiences a deep correction. The goal is to take advantage of lower prices with one big purchase. However, lump sum investing carries emotional risk. If you invest everything at a market peak, short-term declines may shake your confidence. That's where SIPs, systematic investment plans, come in. SIPs allow you to invest small amounts every month on a fixed date. Instead of worrying about timing the market, you invest consistently, whether markets are rising or falling. This builds a habit of disciplined investing and removes emotional decision-making. SIPs masterfully use rupee cost averaging, a principle where you buy more units when prices are low and fewer units when prices are high over time. This reduces your average cost per unit, helping you benefit when markets recover. Rupee cost averaging acts as a shield against volatility because you never try to predict market movements. You simply keep buying consistently, and eventually your investment compounds. This strategy has helped millions of ordinary people build significant wealth without needing to become market experts. SIPs reward patience, discipline, and long-term thinking, traits that separate successful investors from those who quit too early. The heart of mutual funds lies in the fund manager, whose decisions determine the success of actively managed funds. A fund manager's role is intense, demanding, and deeply analytical. They study companies, analyze financial statements, follow economic trends, evaluate risk factors, monitor global markets, and adjust the portfolio based on new information. They respond to market volatility, rebalance holdings, and ensure the fund remains aligned with its objectives. A good fund manager is rational when the world panics and patient when the world becomes greedy. Their discipline protects investors from emotional decisions that lead to losses. In passive funds like index funds, there is no active manager making daily decisions. The portfolio simply tracks the index. But even in passive funds, a manager ensures that the fund stays aligned with the benchmark. Understanding the role of a fund manager gives investors confidence that their money is being handled professionally. Another most misunderstood aspect of mutual funds is fees and hidden charges. Every mutual fund charges an expense ratio, which covers management fees, administrative costs, transaction costs, and distribution expenses. This fee is deducted directly from the fund's returns. A high expense ratio can significantly reduce long-term returns due to compounding. Even a 1% difference in expense ratio may not seem like much at first, but over 20 or 30 years, it can remove a huge portion of your wealth. This is why passive funds have grown so popular. Their low expense ratios leave more money in the hands of investors. In addition to the expense ratio, some funds charge exit loads, which apply when you withdraw your investment within a certain period. Many beginners overlook these costs and end up surprised when they see lower than expected returns. To be a smart investor, you must always compare fees, understand how they impact compounding, and choose funds that give you the best balance between cost and performance. Understanding risk levels and risk profiling is one of the most important steps in mutual fund investing because investors often fail not due to bad funds, but due to choosing funds that do not match their emotional tolerance or financial circumstances. Every mutual fund carries some level of risk, from low-risk debt funds to high-risk equity funds. Risk is not the enemy. Misunderstanding risk is investors must know the difference between volatility and danger. Volatility simply means that the value of your investment will fluctuate in the short term, while actual danger means you have chosen the wrong investment for your time horizon or financial needs. A short-term investor who puts all their money into equity funds is not facing volatility. They are facing danger because the time needed for recovery is not available. A long-term investor, however, can handle volatility easily because market ups and downs balance out over time. Risk profiling helps you determine what type of investor you are: conservative, moderate, or aggressive, and this is essential because it guides you toward funds that match both your goals and your temperament. Risk profiling is not merely about how much money you want to make. It is about how you emotionally react to seeing your investment fluctuate. Some people panic when their investment drops even slightly, while others stay calm even during a major crash. If you are someone who gets anxious when markets fall, equity funds may feel overwhelming unless you have a very long time horizon. On the other hand, if you understand that short-term declines are temporary and are willing to stay patient, equity mutual funds will reward you with higher long-term returns. Your risk profile also depends on your income stability, financial responsibilities, emergency fund strength, and time horizon. Someone with a secure salary, no debt, and no immediate financial obligations can take more risk than someone supporting a family or dealing with unstable income. The goal is not to chase maximum returns, but to find the level of risk where you can remain disciplined, consistent, and emotionally strong without abandoning your investment during temporary downturns. Once your risk profile is clear, deciding the right fund becomes much easier. The right mutual fund is one that aligns with your investment horizon, your financial goals, and your risk tolerance. For short-term goals like building a safety net, preparing for emergencies, or saving for commitments within 2 to 3 years, debt funds and liquid funds are the safest choice because they preserve capital and reduce the chance of sudden loss. For medium-term goals such as planning a wedding, building a business fund, or saving for a vehicle or education within 3 to 7 years, hybrid funds offer balanced growth and stable performance. They reduce the risk associated with pure equities while still providing meaningful returns. For long-term goals like retirement, wealth building, or buying a home after several years, equity funds or index funds are ideal because they maximize compounding. The longer you stay invested, the more powerful equity funds become. A smart investor focuses not on the highest return fund, but on the fund that makes sense for their life stage, time horizon, and emotional comfort. Starting your mutual fund journey is much easier than most people think. Many beginners postpone investing because they believe they need a large amount of money or deep financial knowledge. In reality, the process is simple and accessible. The first step is to ensure you have a clear emergency fund so that your investments are not interrupted by unexpected events. Once your essentials are secure, choose a trusted mutual fund platform or investment company. Many investors begin with index funds or well-rated equity or hybrid funds because they are simple, reliable, and proven over time. Starting can be as simple as creating an account, completing your KYC verification, and setting up a monthly SIP. You do not need to wait for the perfect moment or the perfect market condition. Starting early and investing consistently will always outperform waiting for the right time. Every month you delay is a month of compounding lost, and the long-term impact can be massive. The sooner you begin, the sooner your money starts working for you. Taxes also play an important role in mutual fund investing, and understanding them helps you make smarter decisions. In most countries, mutual fund gains are categorized as either short-term or long-term capital gains. Depending on how long you hold your investment, long-term gains are usually taxed at a lower rate, encouraging investors to stay invested longer. Equity funds often have favorable long-term tax rules, while debt funds may be taxed differently. Dividend payouts from mutual funds are usually taxable as well, which is why many long-term investors prefer growth options. In the growth option, profits stay inside the fund and compound over time, avoiding unnecessary taxation until you choose to withdraw. Taxes are not something to fear. They are simply a part of financial planning. As long as you understand the tax rules and structure your investments accordingly, taxes will not weaken your wealth-building process. In fact, tax-efficient decisions amplify your long-term returns. As you navigate through the world of mutual funds, it is crucial to recognize red flags that may indicate a risky or poorly managed investment. One major red flag is a fund with consistently poor performance compared to its benchmark or peers. Every fund will experience temporary downturns, but a pattern of underperformance is a sign of structural weakness or poor management. Another red flag is a very high expense ratio that eats into your returns without delivering exceptional performance in exchange. Some funds may also show excessive portfolio churn, meaning the manager keeps buying and selling too frequently, which can increase costs and reduce stability. You should also be cautious if a fund constantly changes its strategy, category, or management team, as lack of consistency often reflects internal problems. Investing requires trust, and these red flags help you identify funds that may not be worth your long-term commitment. Wealth building with mutual funds does not happen by accident. It happens through deliberate, disciplined strategies. One of the most effective wealth building strategies is long-term SIP investing, where you contribute to your investments every month regardless of market movement. This builds a strong foundation of compounding and cost averaging. Another powerful strategy is pairing equity funds for long-term goals with debt funds for emergencies and medium-term needs, creating a balanced financial life that grows aggressively without exposing you to unnecessary risk. Rebalancing your portfolio yearly is another essential strategy. When markets rise, equity may grow too much compared to debt, and when markets fall, debt may become dominant. Rebalancing helps you maintain the right risk level and often increases long-term returns by buying low and selling high automatically. The smartest strategy of all, however, is patience. The investor who stays committed for years through both good and bad markets always ends up in a stronger position than the one who constantly jumps in and out based on emotions. While the path to building wealth with mutual funds is clear, many investors fall into avoidable mistakes that sabotage their growth. One common mistake is stopping SIPs during market downturns out of fear, not realizing that downturns are the best time to accumulate more units at lower prices. Another major mistake is chasing the newest, best-performing fund, thinking that short-term returns will continue forever. Performance fluctuates, and chasing trends leads to disappointment. Many beginners also invest without a clear goal or time horizon, which results in poor fund selection and emotional decisions. Some investors withdraw too early, unable to tolerate short-term volatility, and lose out on the enormous gains that come from long-term compounding. And perhaps the biggest mistake of all is ignoring fees and taxes, which quietly reduce long-term wealth if not managed wisely. Avoiding these mistakes ensures that your investment journey remains stable, disciplined, and ultimately rewarding. Mutual fund investing is not about beating the market, predicting the future, or finding the perfect fund. It is about creating a long-term relationship with your money that grows stronger with time. The journey begins by understanding yourself, your goals, your fears, and your financial responsibilities. From there, you choose the right fund that aligns with your needs, not someone else's. You start small, stay consistent, and allow compounding to do the heavy lifting. You stay patient during downturns, rational during market highs, and disciplined throughout every season. Wealth is built quietly, through habits, not through luck. Mutual funds give you a structured, simple, and powerful way to create wealth even if you never become a financial expert. This guide is not meant to impress you with complexity, but to empower you with clarity. With the right mindset, mutual funds can transform your financial future and bring freedom, stability, and confidence into your life.